minutes ago, we talked about Senator Bernie Sanders' opposition to the tax cut agreement President Obama negotiated with Republicans. You can see him here continuing to filibuster on the floor there in the House. Here is another point of view. Thomas Cooley is an economics professor at NYU's Stern School of Business. He co-wrote an op-ed in the Wall Street Journal this week arguing for permanent cut in taxes on capital gains, dividends, and corporate profits, saying the Bush tax cuts don't go far enough in the first place. So welcome to the show. Thanks so much for joining us. Let me ask you about, first of all, about the compromise that the president has made. Surely you don't think it's a bad compromise?
No, I think he got a very good compromise. In fact, the issues that have caused all the uproar, the tax cuts or extensions of the tax cuts on upper incomes, is only going to cost about $150 billion over the next 2 years.
And will that yield growth?
Well, I don't know that it will make a big difference in growth. I think if we really want to stimulate growth in this economy, we need to look at not temporary fixes, but permanent cuts in the tax on capital income. That's what drives growth in the long run.
So what kind of cuts and what kind of impact would it have?
Well, you want to look at cuts on all forms of capital income. And what that does is that encourages the development, the accumulation of capital in the business sector.
By capital income, you mean dividend taxes,
dividends,
capital gains taxes.
Exactly.
And this
corporate
is a different discussion from the income tax discussion that we're normally having on Main Street.
Exactly. Here. Some parts of that fall on individual income, some parts of that fall on corporate incomes. But what really matters is that how much you tax the income, the returns to capital. And if you lower those taxes, then there's more of an incentive to accumulate capital in the business sector.
What's the payoff, though? Because I think a lot of people make statements and we're like, okay, show me the research, show me the payoff here.
The payoff is that in the long run, having more capital in the business sector raises the productivity of domestic workers. And that leads to growth. It leads to higher wages for domestic workers.
But we're pretty productive already, aren't we?
We're pretty productive, but we're not as productive as we could be. And a lot of the capital investment in this country has not been in the business sector, but it has been in housing, residential housing, commercial real estate. The other thing is that we've been growing because of consumption over the last decade or so, because we've stimulated consumption. We really need to focus on the kinds of investments that produce jobs in the long run, and that is the issue of taxing capital income.
So you actually had some cold, hard figures, some numbers. You say that capital income taxes have averaged about 37% between 1990 and 2003, and you would like to see those closer to 20%, right?
If you reduce those to something like 20%, that we estimate that would lead to something like an 8% increase in growth and 3% increase in jobs. And a 5% increase in wages. So in the long run, investing in capital in the business sector is the best way to look after American workers.
All right, two sides of the equation. All right, so
yes.
We're talking about reducing taxes. What about the deficit that continues to move up and up and up? How does that impact? If we make those cuts, Professor Cooley, how does that impact the deficit?
There is no question that we need to do something about the deficit. We are on an unsustainable fiscal path. And so it's not enough just to cut tax rates on income, marginal tax rates on income. We have to think about the whole structure of the tax code. And really what I'm advocating is nothing more than what the fiscal commissions have advocated, which is to reform the tax code, lower the rates on capital income, and lower the rates on individual incomes, but broaden the base, eliminate a lot of the tax expenditures that are now costing us a great deal of money, and more importantly, giving us inefficient allocation of capital.
You gave an example in your op-ed about a period of time where raising capital income taxes was bad for growth, and that was England after the Second World War. What about the opposite? Have you got an example of a country that lowered capital income taxes in a recovery like this and actually was able to boost growth through it?
Well, I think if we look across the world, there are a lot of examples of countries that have lowered the taxes on capital income and boosted growth. Britain, in the era after Margaret Thatcher, Germany more recently, they have reformed their tax structures, and they have less onerous taxes on capital income, and that's improved their growth prospects.
All right. Hey, Professor Cooley, thanks so much for joining us. Thomas Cooley, professor at NYU. We're